We are having this special chat with Paul Gruenwald, Global Chief Economist at S&P on ET Now. Paul, thank you very much for your time for chatting with us.
Great to be here.
Let's start by understanding your broad view on Indian economy right now in relation to how global growth is, or large pockets of global growth, US versus Europe versus Asia, and within Asia, India and China.
Yeah, well, first of all, India is one of the high growth stories right now. You guys have put in a raft of structural reforms. We had digitization, we had the bankruptcy law, we had GST. We think trend growth is about 7.5% right now, which means you can double GDP every 8 or 9 years. So it's been a good couple of years on the structural reform front, but India's moved to near the front of the pack in Asia as of right now.
We are also having this chat in the backdrop of last couple of months of rough weather on our own macros, because the rupee is down close to 7-8% on a year-till-date basis. Crude oil prices have rallied, and we are a economy which gets impacted by that large import bill on crude oil, and overall macros have come under pressure. How are you analyzing the situation? Do you think India will weather this storm in the medium term? Because 3-4 years back, we were actually in a great sweet spot.
Yeah, well, first of all, if you go back further than that, to 2013, India got hit by the taper tantrum, but that's when your current account deficit was much larger, right? So current account deficit is much smaller. You're right on the vulnerabilities. India has a large oil import bill, and the rupee's been weakening. So if those two both go in the bad direction at the same time, let's say oil prices go higher and dollar or rupee goes higher, then that could be challenging. But what we're seeing now is oil prices seem to have peaked for now. The futures curve is downward sloping. The currency is going to be trickier, right? If we continue to go down this path of trade friction and markets get nervous and they want to de-risk, I think there's going to be some continued pressure on emerging currencies, including the rupee.
Talking of currency, we are almost past 68.5 now, and the dollar index continues to rally almost 95, bringing along all the emerging market currencies under pressure. And of course, the new worry at the horizon is the trade war related risk aversion, which we are analyzing. How do you see this trade war related risk aversion, and how vulnerable are emerging market economies like India and hence emerging market currencies as well?
Yeah, well, I think the trade war is the #1 risk on our macro screen right now. It looks as if things are intensifying. It's unclear whether we're going to go down the bad path for a trade war or maybe move to a discussion about investment between US and China. We'll have to see. But you're right, the emerging markets get sucked into this in two ways. First, if global trade starts to slow down, emerging markets are typically more dependent on trade than advanced markets. Not true for China, but in general that's a case. And then if we get the volatility around the trade friction, that's going to make servicing emerging market foreign currency debt higher as well. So that's not a particularly good scenario for emerging markets.
So, till last year, the general belief was that global growth is actually moving up in a synchronized fashion. But because of spike in crude oil prices, a lot of crude importing economies are at risk. And of course now Europe is also perhaps not the same shape as we thought it is a year back. Do you think that entire hypothesis of synchronized global growth is kind of getting challenged in a way?
Yeah, well, I think, that was a great story, right? Last year we had the synchronized upturn across the US, Europe, and Japan. The story's not quite dead yet, but we had a soft quarter in Europe and we had a negative growth quarter in Japan, whilst the US is picking up. So we seem to be getting some divergence now. It's not entirely clear that story's totally gone. The US will have a couple of good quarters and then revert to trend growth. If Europe can get through the soft patch on Italy and then Japan bounces back, we could go back to some of that, but I suspect the nice synchronized upturn story is probably not going to be the main theme for 2018.
Okay, let's talk about US. You come from that region and you know the economy very well. What is the shape of US economy right now? The message which the US Fed has given out so far, how many rate hikes is the market pricing in? And can there be a variation? Because the dollar is continuously rallying. How are you seeing all those factors play out?
Well, first of all, let's look at the macro, right? The US has had a very long, very shallow recovery, but now the economy is running above potential. The output gap is closed. The labor market looks pretty tight. Unemployment is at a 18-year low. So from that perspective, things look good. The tax cuts are coming at a time where there wasn't a lot of slack in the economy. So we do think we're going to see a pickup in growth for the next couple of quarters. US growth could be 2.8, 2.9 this year, but we don't think those are reforms that will increase the trend growth rate in the US. So our US economists still see growth, trend growth at about 1.8, 1.9. In terms of the Fed, we've had 4 rate hikes assumed for this year. That's the current market pricing. As the Fed says, that's very data dependent, but for now, the path seems to be higher US growth in the short term, 4 rate rises this year, probably 3 more next year. But again, that's going to be subject to how things play out.
So as we were talking earlier as well, if US and China continue to dig their heels on trade war related tariff related issues, do you think that number could also come into question? And up till now, the commentary which has come in both from US and China, how are you analyzing that?
Yeah, well, the trade war really hasn't showed up in the data yet. First, these things take time, but the trade impact itself is usually relatively small. What's going to move the needle here is the so-called second round effects. So there's a lot of uncertainty, firms stop investing, consumers stop spending. If the tariffs are high, we're going to have to reallocate production. So, you know, in the long run, we're not going to change our growth path, but we might be on a lower path than what we are now, and that's disruption that could potentially take down growth. Again, we're not there yet. We're still at a point where the escalation of tensions is something we're watching, but we're not ready to throw in the towel yet on the scenario we talked about for the good global upturn.
So thankfully, India is relatively less vulnerable to that because our exposure to global growth is limited and we are more domestic economy. How are you looking at the health of Indian economy right now and the data points which your team must be providing to you?
Yeah, well, we had a couple of rough patches over the last few years, right? We had the demonetization and then we had the launch of the GST, and growth had fallen in both of those episodes. There was a debate on whether India actually had a structural growth story or whether this was the beginning of another soft patch. I think the data that came through most recently, where growth is about 7.5, validated our view of our crystal economists here in Mumbai. But yeah, that path looks like it's in pretty good shape. The one thing that was really heartening was to see investment pick up. Investment has been the missing component of the Indian growth story. And if we're telling a longer story of trend growth picking up, investment picking up, urbanization, rising middle class, all the infrastructure that goes with that, that's part of the story, and the fact that we're now seeing some investment, I think, is good. So we're pretty confident, at least for the next couple of years, that the trend growth rate's about 7.5.
Did you analyze, or did you happen to read the way RBI commentary was in the recent monetary policy meet? They also spoke about capacity utilization improving our economy and growth, and compare this reaction to the commentary was pretty interesting. Bond markets did not react violently, stock markets cheered actually. And do you think, how do you see RBI's role in spurring growth into the economy, at the same time trying to keep a lid on inflation, even if they are from external factors?
Well, I mean, the job of the RBI is to make sure inflation's in the target, which is 2 to 6. So I guess Governor Patel and company are trying to keep it sort of steady and in the middle and anchor expectations. So the central bank really can't raise the growth rate, but they want to create a stable inflation environment and financial stability. So I did read the statement very quickly. It seemed to confirm what the market was thinking. If the central bank is taking actions that are sort of in line with what the market's thinking and they're well aligned, then you don't get too many surprises. And that's what I think we saw out of the recent statement. There was the rise in rates because of oil price-led inflation, but not necessarily the beginning of a tightening trend.
Also, there's a lot of talk about how the current government leadership has a role to play in implementation of some of the reforms. We may talk about what all they intended to do and how much have they managed to do in these many years. But out of the work done so far, how are you seeing some of the work done? How are you analyzing the work done so far?
Yeah, I think the big thing for us is to make a distinction between reforms that increase trend growth and reforms that increase short-term growth. Okay. So if the reforms we talked about earlier, whether it's the digitalization or the bankruptcy law or the goods and services tax, these are the things that raise trend growth as opposed to, say, a short-term tax cut which may boost growth in the next couple of quarters, which is what we're seeing in the US. So to the extent the government's been able to do that, and to the extent that those efforts continue, that's part of a good story.
And lastly, how are you looking at the urbanization trends take shape in India? And the reason also I ask you that you are someone who has seen similar kind of story play out in different economies when they are on the journey of a frontier market and just emerging economy to a reasonably sized large economy. What kind of trends are you observing for India?
Right. Yeah, well, I've been following Asian economies for over 20 years, and we've seen that story before. It's a good story where the economy undertakes a number of reforms, you open up and then you start to grow and urbanize. India's urbanization rate is about 30% right now. Most emerging markets are around 60, China just passed 50, but there's a long runway. If we go back to our story about structural reforms and trend growth, there's a long runway driven by foreign direct investment, productivity growth, urbanization, rising middle class, rising incomes. All of those are ingredients for a sort of long, steady growth trajectory if we keep the reform agenda going. So India's got a big gap to close with the rest of the region, and if we stay the course, could be in for a nice stretch and prosperous growth. So we'll have to see if how that plays out.
Great. Paul, thank you very much for your time today. It was wonderful chatting with you.
My pleasure.
Thank you.